Hello, everyone. Welcome to the third quarter Klaas Financial webinar. Thank you very much for joining us this quarter. Not a lot's happened this quarter. It's been good. It's been a wild and thrilling quarter, and we're excited to share some stuff with you. My name is Josh Stirling. I'm the Chief Investment Officer here at Klaas Financial. Today, I'm joined by Eric Schwartz, one of our investment advisors. And then we also have Kite, our Chief Financial Officer. But housekeeping, today our presentation should last about 30 minutes. At the end of the presentation today, we will have a section for Q&A. At the bottom of your screen, you should see a little button that says Q&A. If you have any questions as we're going throughout our presentation today, go ahead, click on there, enter in your question, and we'll have some time at the end to go through that with you. So today we're going to go through a couple of different topics like we normally go through. First, Eric is going to share some news with us on the economy. Then after that, I'll go through some information on some of the diversification benefits that we've seen investing internationally. Then finally, Kyle's going to take us through the benefits of diversification with bonds, stocks, and every other asset class that we have out there. So before we jump into our presentation today, a couple of quick reminders of who we are. So Klaas Financial has been in business for about 49 years, coming up on our 50th anniversary just next year. We serve over 1,000 households across America, and we're servicing clients in about 32 states out of 50. We have about 25 employees at our company now, hitting new numbers all the time. Every quarter, it seems like that number is going up. But we're really, really blessed to have all the different families, households, and businesses that we work with that help our company keep on growing and helping to serve you, invest, and plan for the future. All right, so Eric, tell us about the big topic that's been happening on Capitol Hill.
Yeah, I have the news this quarter, and it's probably hard to miss, but in case you didn't know, on October 1st, the U.S. federal government shut down, and we are sitting here on October 16th. Frankly, with no end in sight. Largely, the shutdown is related to disagreements over healthcare funding, and specifically how we fund programs like Medicaid and how we subsidize insurance premiums for folks on the Affordable Care Act. So as we sit here right now, obviously we are talking to a lot of clients about the impact of not just the government shutdown, but decisions that are being made right now in Washington. And for clients that we work with, we have a fair number of clients who are retired and not yet eligible for Medicare. They're not yet 65, and a fair number of them are participating in a plan from the Affordable Care Act. So this is definitely not just a disruption for folks, but as we move towards premiums and plans for next year, a lot of uncertainty out there for folks. So frankly, it'd be nice to see this end very soon so we could get a little bit of direction. But we'll see, and there's more than just the impact is more than just what they decide on healthcare spending, because there's impacts beyond that. I mean, outside of federal services being sort of cut back, and anybody who's traveling, fewer TSA agents, right? There's a big impact of this. But when we think about it, on the economy, we have reduced government activity, reduced government spending that'll hit GDP. And the big thing I think of is a lot of the data that the Federal Reserve uses to make decisions about where interest rates are, and big high level decisions. We're not getting that data while the government is shut down here. And as the Fed tries to navigate potential rate cuts here in the near future, it's really important that we have good data. And so this just makes that process a lot. Well, it makes you a little bit more nervous as you think about the Fed making some of these decisions. But as we sit here today, no control. We have no control over whether or not the government reopens here anytime soon. But I want to talk a little bit about the economic data that we do have. So Josh, if we could jump to the next slide. Because we can get lost in the news, we can get lost in sort of everything that's going on around us. So at each quarter, we try to sort of ground ourselves and look at where the key data points are compared to history, right? So as we're looking here on the slide at GDP, unemployment, and inflation. So just starting with real GDP here, we are sitting at about 2.1%. Historical average is closer to 3.2%. But I think it's fair to say overall, the economy remains pretty resilient. We had a really tough first quarter in terms of GDP growth. It sort of bounced back in a big way during the second quarter. So, as much as we may hear doom and gloom, GDP continues to surprise us, I think, here, especially in the last couple of quarters. Moving on to unemployment, we're sitting at 4.3% currently, almost a point and a half below the long-term average. So it looks pretty good in a historical context. There definitely are some signs from the labor market that it is beginning to soften. We've gotten a few just in the last few months. We've gotten some revisions to previous jobs reports that actually showed we created far fewer jobs than we initially had thought. So things like that obviously don't make us feel great, but as we sit today, we are below that long-term average on unemployment. And finally, inflation. I feel like, Josh, we have been talking about inflation for 3 years.
Yep.
Because we have. But as we sit here today, we are elevated still above the Fed's target rate of 2%. We are below the long-term average of 3.5%, but we are sitting above where the Fed wants to see us. We have gotten some recent consumer surveys that, suggest that folks are just kind of expecting that some of these higher prices are here to stay for a bit, and we may actually see some increased inflation in the future. Now that's just consumer sentiment. It doesn't decide. It doesn't make policy decisions, but that core inflation remains pretty sticky, and we'll see, what, as hopefully we get some new data in, but the Fed's got its work cut out for them. So yeah. It's a tough choice.
Yeah, I think with the news of just the current workforce, the softening of it, it's kind of surprising to sit here and look at the long-term average versus what it's currently at.
Yeah.
I mean, years past, 5% was considered basically full employment. As just before COVID, I feel like there was a big conversation around, oh, you know what, 4% is the new full employment. And we've been in that 4 to 5%, excluding COVID, for quite some time. And it just goes to show the strength of the U.S. Economic workforce. It's pretty incredible to see how strong it's been and how consistent it's been over the past couple of years. Right. Thanks, Eric. The next part that we'll kind of chat about, myself and Kyle are going to chat about a couple of things here that are directly related to the main thing that we talk about all the time when we talk about investments, diversification. And it's a big, big deal when we talk about a plan for everybody's financial future, investing in practical portfolios that have diversification added in many different ways. One of the main things that we'll talk about first here is about global portfolios when talking about the stock market. And we've talked about this a few times already this year, that international markets have been really the driving force of the overall stock market returns on the year. We've talked about some of the things about why that's happening, but we'll dig a little bit deeper here today. So far in the year, as everybody knows, the U.S. market has been a little bit bouncy. Back in April, we saw a a deep cut in the S&P 500, but surprisingly, we've come back pretty strong. The S&P 500 is up about 14% year to date. And I think back to mid-April, and I definitely wouldn't have predicted that. But a part of the market that's done incredibly well has been internationals. The MSCI ACWI is the all-country world index minus the US. And those have been over 25% year to date, almost double what we've seen from the US. And that's been really, really promising to see. Now, when you dig underneath the hood, you might say, well, was it just one country or is it a certain sector? And no, we've really seen this play out kind of across that total economy. We've seen countries like China, Germany returning over 30%. We've seen Italy returning over 40% year to date, just really powerhouse returns. You might look at sectors, and there's really been broad support across most sectors. So Nestle, for instance, out of Switzerland, a consumer staple, returning right alongside the US returns. You see Taiwan Semiconductor, which is in the IT space, having a monstrous return on the year. Sony, your consumer discretionary. Then Shell, your energy out of London, also performing pretty much close in line with the All Country World Index. And so seeing this broad support, you might wonder, well, is it really just kind of we'll call it geopolitical risk in the US or some of the things that have been happening in the US throughout this year? But it's more than that. International markets have really had a benefiting kind of foundation of why people want to kind of move funds there, why it's been a really high return on the year. Some of the key things, because we could talk about this for hours, I feel like, but we'll kind of keep it high level. So one of the big things in my perspective is a lower PE rate. Right now in the US, and to explain PE ratios, it's price over earnings. So price, basically what you pay per individual stock, and then earnings, what every single stock gets in earnings compared to or for that company. So the higher the price and the lower the earnings, well, it's hard to make kind of those numbers work if prices get too high compared to, well, what is that company earning me for my investment in that stock? The US has historically been pretty high. Recently, it's been around 27, even 30 for its price to earnings ratio. In the international market, it's sitting at about closer to 17. And that big deviation shows that international markets have really kind of been a value. You can go put your money there and there's hopefully a little bit more certainty there. There's not as much concern about future earnings. The US market has kind of jumped quite high to the point where you hear this line, the market is basically predicting that these companies must be perfect and it always exceed earnings expectations going forward to hit their numbers, which could be a really tough thing. You look at international markets, and that's not kind of the reality that they're living in. Of course, international markets over the last 10 years have not been competing in line with the US, but now we're seeing periods of time like this year to date, where you've seen the support returns. On top of that, US markets, you've seen this concentration of the top 5 or 10 stocks. The Mag 7 have made up 25% of the S&P 500. And you hear people encouraging kind of diversification beyond that. They don't want to be concentrated on just a handful of stocks. Well, being globally diversified helps provide that solution. And the other thing I'll point out that kind of investing internationally is that you get these diversification of different favorable economies. Over in the EU, for instance, you have rates that are a little bit more attractive. In the US, the Fed funds rate is sitting at about 4%, but the European Central Bank is sitting at about 2%, meaning it's more attractive for businesses to be able to invest and to produce new lines for revenue, to grow their companies. Makes it just cheaper and more affordable. Not only that, you have slightly lower inflation. It's only about 0.5% lower than the US. that can be meaningful, a little bit of stability as well. So there's a lot more that we could go into there, but international markets have kind of shown their benefit this year for diversification. And it's not just from some of the things that have happened in the US so far this year. Now, looking beyond just the stock market, we'll talk through bonds here real briefly, and we're going to talk about this a little bit more high level compared to internationals. But just to kind of lay out what we're going to chat about here, we'll talk about the concept of bond interest rates versus bond prices. So right now we're going through a period of time where bond interest rates might drop. So if you were to hold a bond, $100 worth of a bond, and it's paying a 5% coupon rate to you, that is worth $100. Now, if the general market has their interest rates drop, so a new issued bond now only pays 4% when your bond pays 5%, people are willing to pay more for your bond because it's paying more on its coupon. And because of that, the price of your bond goes up, whether it's 101, 102, 103, depending on what type of bond it is. Your value of that bond has risen because interest rates have dropped. It's this teeter-totter effect that you might have seen. When interest rates go down, prices go up. When interest rates go up, prices go down. And well, we experienced what that part was back in 2022. The Fed went through an interest rate rising environment, and we felt the pain in the bond markets. You had double-digit losses in that when bonds are typically looked at as kind of the buoy to the stock market, really kind of helps benefit your overall portfolio. Now, you do get the benefit of having higher interest rates, and we've benefited from that over the past few years. But the one thing that I think can be lost a little bit in the noise of it is the position of the bond market that we're at now. And so when we look at the right side of this screen now, what we're looking at is previous historical time frames, basically the times before the Fed began to cut their interest rates. And so we have these different time periods, and I do have to be honest, yes, these are recessions. No, we're not trying to predict that the next recession is coming up, but we just want to lay kind of the groundwork of diversification, the benefits of bonds, and kind of where we're at currently. So we're looking at these different time frames. July 1990, you're looking back at the Gulf War recession, 2001, the dot-com bubble, Great Recession 2007, COVID 2019, 2020. But those are the time frames right before the Fed began to cut rates. And then to the right of that, you're looking at the US aggregate bond index total returns. And these are cumulative returns. So 1 year later, how did the bonds return? 3 years later, how did bonds return? 5 years later, how much did they return? And you can see here that in almost all of these scenarios, bonds returned quite a bit, more than you would normally expect off something that's paying 5%, 4% interest rates. And that is because of that mechanism of the Fed cutting rates. So back in 1990, you had interest rates cut from 8% all the way down to 3%. That is a huge shift. And you can see that in the overall returns. 5 years later, your bonds returned 50+%. That's incredible. That's a huge benefit. Now, as we kind of go down that line and you look at August 2019, you see that interest rates were sitting at about 2.4. And that was after the Fed had raised interest rates from about 0.5% to 1%. We had a period of about a decade where interest rates were pretty close to zero.
Yeah.
And so you can see that the movement from 2.4%, and it actually went down to about zero over a period of about a year or two. You see that the returns on the bond market did not really react the same way. And so the system the Fed relied on for such a long time, their tool of manipulating the interest rates really wasn't too powerful back then. But now with where we're at, sitting about 5.3, interest rates have come down a little bit since September of last year. We're sitting in a really solid place where the Fed has the tool to be able to use to adjust interest rates. And sitting here right now, not only do we have the benefit of if the Fed keeps reducing rates, bonds are going to increase in value, But we're also sitting in an environment where you're getting paid more for the bonds that you have today, which is a huge benefit for people who are investing in the bond markets. And it really helps out on kind of normalizing your stock bond mix when stocks may be more volatile. Overall, we're in a really good position where bonds are paying a lot more, and is well positioned if there is any turbulence in the future. We're hoping that that's a long ways away, and we're hoping we're just going to get paid really nice coupons as we kind of jump along. But we're in a really solid spot. And honestly, we haven't been in a spot like this since about the late 2000s, right around that Great Recession time.
Yeah, I think clients forget, well, everybody, but especially clients that we work with, they'll forget about the bond portion of their portfolio because we all tend to focus so much on the stock market. But the bond is sort of the bond exposure is the anchor of your portfolio, right? Especially if you're in retirement, that's what's generating, monthly dividend payments. It's helping to support your withdrawals, and I think sometimes we're sort of lulled into this idea that, well, whatever's not in the market is just kind of not doing anything. It's safe, but it's not really doing anything. When that's just not the case. It's more hopefully more stable, but still also providing that total return as well.
Absolutely. And so the next slide we're going to look at, Kyle's going to go over, but keep in mind here, we're going to look at the same time periods that we have up on the screen right now, that July 1990, 2001, 2007, and 2019. So Kyle, I'll hand it off to you to chat about the benefit of stocks versus bonds.
Yeah, thanks, Josh. Yeah, so this is just kind of a graphical representation of what Josh was just explaining there. So as we mentioned before, if you look at most of these graphs on the screen have a similar kind of trajectory to them, meaning when the orange line goes down, the blue line goes up, except for during COVID. So that's why we said COVID was such an anomaly, that 2022 timeframe when stocks and bonds were both getting hammered. And Josh just laid it out. It's because interest rates were very low before they started hiking rates. So using that simple analogy, if you can go buy a new bond that's paying higher interest, your existing bond that's paying that lower interest rate is going to get pushed down in price, right? So that's exactly what happened back in 2022. And bonds didn't work how they have historically when it comes to stock market corrections. But you'll notice in all these other scenarios, bonds tend to be more stable and they tend to push higher during volatile stock market times. Again, it becomes to the nature of bonds where you're getting that fixed interest payment. So if you hold a bond to maturity, you know exactly what you're going to make on an interest payment wise. Stock market doesn't have that guarantee. It's going to go all over the place. Typically, yes, it goes up and to the right if you hold it long enough, but you're going to have some times throughout there that it's going to get hit, obviously. So bonds are much more stable. They're much safer. And this is why we always keep a piece of these in retirees' portfolios. So, like I said, 2022 is the most recent one, and nobody liked bonds because they were getting hit. They weren't working as a buoy like they usually do, but we had to keep preaching that they're there for a reason. They're there for a reason. And now we're getting to that point where you're starting to see that. Again, we're not saying the stock market's going to go down or anything like that, but it's going to go down at some point. We just don't know when. And bonds are much better positioned to be that buoy as they have historically. And so that's why we wanted to illustrate this.
It's helpful to see the blue line of bonds being incredibly stable, even though it might not be positive in every single frame that we have here. It certainly moves a lot less than the orange line. Just really showing that proof of concept that it has a lot more staying power than the overall stock market does.
Now, Josh, Kyle just said that we know that at some point the stock market will go down. We just don't know when that is. Now, I assume you do know that.
Yeah, it's going to happen next year.
Okay, good.
But good. Now I'm going to be wrong. So it's going to keep going up. We'll have another 20% year.
To be clear, we are kidding. But yes, of course.
All right. So this is the Callan chart that we showed, I think, a couple of quarters ago on this. We like this because it's a very, very good illustration of the different sectors that we've been talking about here. So if you look on that kind of top line there, you'll see that for the last, at least 8 years, 9 years here. We've had pretty much US or bonds being the winner. And emerging markets was all the way back in 2017, but that was just a 1 year blip. You got to go all the way back to 2012 or 2009, 2010 for that emerging markets to kind of take control and be your number one leader. And then if you look, international, the gray bar has not been the number one leader in a very, very long time. So this is why, you've had to preach this diversification. You hold international for diversification purposes, and this year it's finally starting to pay off. Whereas Josh mentioned earlier, international is actually up quite a bit this year. But again, we always focus on this green line, that 60-40 portfolio. You're just kind of hitting right down the middle there, which is, again, as you're in retirement, we want to try and cushion out some of this volatility when we can, but still get some decent returns. And it's performed very, very well at doing that.
Yeah, I feel like this is one of my favorite charts that we have, just because it just shows the consistency and the staying power of the 60-40. There's just a lot of noise out there in the world on what you should be doing, what you should be investing in, and nobody has the answers. Trends happen for a long time, and then they're not there. But the thing that is consistent, the thing that is widely regarded as the only free lunch is diversification, 60-40 portfolio. And it doesn't work out all the time. It certainly goes down every once in a while, but it tends to be the most consistent and practical approach to remain in the stock market when times get tough.
Yeah, and I think what is hard to quantify just looking at this is, the 60-40 is probably one of the more popular portfolios among our retirees and close to retirees, right? And the consistency is just so key here, because in many cases we are drawing off of these accounts to generate monthly income for clients. And while it's great that it's kind of performing in terms of returns near the middle, it's also great because we're seeing a lot less volatility, right? And when we're looking at drawing money out of a portfolio, in many cases on a monthly basis, that consistency is worth a lot, even if you don't see that, in the numbers here on the screen all the time.
All right. Well, with that, we will go ahead and turn it over to some Q&A. So if you have any questions, go ahead and please submit some of those questions to us, and we'll go ahead and read them right now. So we did have one question that is directly related to the last screen that we just looked at, so bear with me here for 1 second. What is fixed income on the Callan chart? Would you mind taking that?
Absolutely, yeah. So fixed income is representing, it's kind of an interesting name, I've always thought, for bonds, because it's not necessarily that they're fixed or guaranteed, but fixed income is representing the bond exposure. And I believe on the Callan chart it is the US Ag, so the US Aggregate Bond Index. Think of it just as the more conservative portion of your portfolio that's built more for stability than tons of growth.
Yeah, I think the time that you'll see it being at the top of the Callan chart, being the best performer on the year, is when times are tough. Back in 2007, 2008, those kinds of times. That's when you see it be the outperformer on the overall market.
Yeah, and the fixed income, that relates to the fixed interest payments that bonds pay if you hold them to maturity, obviously. So that's why it's called fixed income.
Yeah, it's a very, very generic term that not the best. We just call them bonds, fixed income. Yeah. All right. I love this next question. What are your thoughts on the proposal to shift from a quarterly reporting requirement to semi-annual for public companies? This was kind of a small piece that got announced recently, and it's just a proposal. It's nothing in play or anything that's going to come down the pipeline anytime soon. But it's talking about public companies that are publicly listed, that you're invested in the US stock market. They have a requirement right now to report on a quarterly basis. So every single quarter, they have their entire business team, their finance department going in, putting together all their balance sheets, their income statements, their cash flows, They do a quarterly call. They release their figures to the analysts out there, a report of essentially the health of the company and how they're doing, what they're working on, what their future projections look like, all this work that's put out there. And they have to do this every single quarter. And it's been built into the system for decades. And it's been a very reliable source of information. Analysts have become so reliant on it. And it helps to kind of build a transparency inside the system. So when you hear that there's a proposal out there for going from a quarterly to a semi-annual, well, your first gut reaction might be that, this might not be the best thing. I don't give this too often, but I'll give an honest opinion on this. I don't really have a strong opinion either way on whether or not we should go quarterly or semi-annually. There are positives and negatives for all of it. And there are different economies out there that do this. Over in Europe, it's pretty common that public companies report semi-annually. I don't know if people really know that, but it's a matter of fact for quite some time. It's really interesting. The UK actually came out, and I think right around 2007, 2008, they came out and shifted from a semi-annual to quarterly to improve transparency, to increase that frequency of data. And then by 2014, removed it and went back to semi-annual. The whole European continent has been semi-annual for a very long time. So, and really the big reason for that is that, well, one, it's a huge burden on corporations to do, even though in those economies that still do semi-annual, they'll still voluntarily do quarterly reporting. But secondarily, there's a concept of quarterly reporting promotes short-termism, which is basically, hey, public companies just want to hit their numbers this quarter, so the value of their stock goes up. But then the next quarter, they got to hit their. So it really promotes companies wanting to just kind of take shortcuts and just improve numbers just for the sake of continuing to improve their company. So there's pros and cons to both of them. Currently, right now, the US is quarterly. Might it? Should it move to semi-annual? I'll leave that to everybody else. I do not have a strong opinion on that.
I'm just laughing a little bit here because you did tell us, you said, I don't normally give a strong opinion. I'm going to do it right now. And it is that I don't really care. No, I think what's interesting about this especially is you'll hear this from business leaders. I mean, companies will make the decision to, even public companies will make the decision to go private because they feel like that gives them more of an opportunity to make long-term decisions without having to come to the shareholders every quarter and say, well, the numbers weren't as good as we expected this quarter, but just wait, the long-term outlook is really good. And there is some massaging that they can do around that, but sometimes the privacy can be powerful for the organization as well. So it's a really tough call. I think my personal opinion is going from quarterly to semi-annually. I don't know that it changes things that much. I think you're still going to have that short-termism because it's just going to be on a semi-annual basis rather than a quarterly. But it's interesting to think about it either way.
Yeah. All right. So we have a question here. You mentioned the PE ratio of the S&P 500 being high right now. What is the current ratio? What is the average of the S&P 500 PE ratio over long periods of time? So this is something that does ebb and flow. I won't be able to give you a direct answer at the moment. The number that I referred to earlier being 27 is based on the Russell 3000, which is looking at the most of the US public stock market. That has risen up over the past. I want to say it used to be around early 2010s, but we've seen this slow trend upwards over time. That's something I can certainly get back to you on, and with more specific information, you can chat with your advisor. I'd be more than happy to hop on the phone with you. We'll look at some live data utilizing some of our tools in the back end to look at that together. All right. If I have bonds whose value is decreasing, how can I decide whether to sell at a loss so as to buy new bonds at a higher interest rate? This is an interesting question.
Yeah.
And I would first kind of chat about this in terms of the concept of investing long term within the bond market. Just like how you can make that argument on the stock side, hey, the value of my stocks are going down. What should I sell to kind of like sell off here for bad stocks versus this one is a good one? I would look at this as being somewhat similar to kind of the market timing concept. We don't have strong conviction of when or where interest rates are going to move in the future. Interest rates are really kind of one of the main catalysts to how bonds are going to be priced. So when you see the value of your bonds going down or up, that's a general market movement happening over time. If you were to go and sell that at a loss, what you'd then be able to turn around and buy on the open market, even though it would have a higher coupon rate, the amount that you'd be able to buy would be nothing. It wouldn't be more than what you'd be receiving on your current bonds because you couldn't buy as many bonds.
Right.
And that's kind of the big thing. Even though the value goes down, but your interest rate is different than what the current market is paying, you wouldn't be able to make it up by selling and then buying on the other side of it.
It's a little bit like saying I have a stock that's doing poorly. I want to sell it and buy the one that's been doing really well. And it's like, well, okay, you pay a lot more for it, you know. And
Well,
I go ahead, Kyle.
It comes down to the whole structure of a bond too, right? Because if you buy a bond and you never sell it, you buy it at a certain interest rate, you're guaranteed that interest rate for as long as you hold that bond. So if you never sell that bond, you know exactly what type of return you're going to get. So it's only if you're selling bonds that aren't at maturity is where this becomes a thing too, right? So that's something else to be aware of.
No, but that's a good question because it makes logical sense that if the market is giving you 6%, but you have a bond that's paying 2%, well, you should sell that bond and then buy 6%. But with the way that your current bond will adjust pricing, it's being adjusted because of that bond that comes out. So it's tough to make those shifts.
Could you speak? I think what could be helpful in this case, because when we talk about bonds, we're talking about individual bonds, but for our purposes, for our client purposes, they're investing in funds or ETF of bonds. So how does that play into this, I guess?
Yeah, so that's actually a really good point because ETFs or these mutual funds are basically pooled investment vehicles where you put your money into it and then all the aggregate money is going out and buying all these different bonds underneath that. And so when you go and you look at, okay, what am I invested in? Well, you're invested in thousands and thousands of bonds. Every single day, those bonds are coming due and you're getting the principal back. And then those ETFs are taking that cash and then buying those new bonds that exist out there on the market. So over time, you are going to be getting that new higher interest rate that's out there on the market. It just takes time to kind of come into play in your portfolio. You'll see the losses on day one as interest rates increase, but over time, you'll see it march back up as you're getting higher interest payments and you're reinvesting into those new bonds that are coming out. It's kind of unfortunate because it's all kind of behind the scenes happening under these ETFs, but that's the reality of what's happening.
Well, we saw it work in 22, right?
Exactly.
We saw it happen.
Yep. But that's a phenomenal question. We could probably go on for quite a bit.
We could. Yeah, we could.
All right. We'll go ahead and we'll make this the last question here, but another good one. If one is looking to withdraw a large amount next year, would you leave it in stocks or do something else?
It's a really good question.
This is the one that we always get when we're trying. This is asking us what our crystal ball says without asking us what our crystal ball says, right? So,
yeah.
So we'll be general.
Yeah, go ahead, Kyle.
I said in general, if you have a large expense coming up in a few months, generally speaking, you want to be careful leaving that invested because you never know what the stock market will be 3-6 months from now, whenever you're ready to pull that money out. If we knew that the market was going to be higher 6 months from now, we would absolutely tell you to leave it in and make as much interest as you can. But the reality is nobody can predict that. So in general, good financial planning is if it's coming in the next 6 months or so, you should probably have it sitting in cash just so that you're avoiding having to pull it out and the market's down 10 or 20%, whatever the case may be. So
That was going to be my answer too, Kyle.
Yeah, well, and I think it also depends. This is really when it comes down to personal financial planning, touching base with your advisor, kind of getting their feedback, because it really depends on what you consider a large amount. If we're talking 3 to 5% of the accounts, that's pretty normalized. Even though it might be a big dollar amount, it might only be a small percentage of what your account is. But if you're talking about selling off and withdrawing 50% of your account, that's a different story, and that you might want to have that kind of in cash ready to go sooner rather than later. But it all depends on the situation. It all depends on what you're looking to do. So it's tough to give a one size fits all, but those are some of the different things that we probably consider.
I'll add one other piece to this, and I've talked about this with a lot of my clients. I think when people get their statements and you're looking at the value in the account, right? That's the one number. Did it go up? Did it go down? And so we tend to think of like the account as a monolith. It's just one thing. It's one investment. But those, I mean, that portfolio, unless you're in a fully, equity portfolio, has stock, it has bonds, it has all sorts of sub genres of each of those things. And so even though, for example, you could say, well, the value of my account went down from 6 months ago to now, and I need to take money out. Well, it's not as if everything in that portfolio lost value. You still have, let's say you have 30% of your account in bonds, right? Just because you have that invested in your account, you have let's say the withdrawal is $20,000. I don't know what it would be. If that's in a $500,000 portfolio, and that portfolio has 30% of the account in bonds, well, you actually technically have $150,000 in bonds in that more secure part of the portfolio. So even if the stock market is to get hit and decline in value, it's not as if all of your account is in that one type of investment. So even though it's one line item, you look at it, you see the balance, that doesn't mean your whole account is invested the same. I don't know if this is making sense, but it's helpful.
Yeah, I think
for sure. Yeah.
I think from a very simple perspective, if your stocks are down but your bonds are up, you basically say, hey, I need money out. The investment management team is going to go in and we're going to select and pick out what is the best way, most efficient way to kind of get this money out of the portfolio. And if the stock market's down, bonds are up, well, we're going to look at the bonds as one of the first places to utilize that distribution from, really minimize that impact so that the stocks have a chance to rebound and come up. That's stuff that we help with on the backside that, I don't think is talked about a ton. All right. Well, thank you very much, everybody, for joining us today. We'll be back next year for our year-end review. Thank you so much. Bye.
Bye, everyone.
Nice.